We're back with John Zechner of Zechner Associates. We've talked about how you're mostly long, not very fully invested, but mostly invested in the markets, preferring, liking what's happening in bonds. But I do want to talk to you about stocks as well. The energy sector is very interesting because we mentioned oil prices are down at that 2-month low. But the energy stocks as a group have been kind of resilient and have held up, particularly on the TSX. Is this a sector you're still pretty keen on? Yeah,
well, I still like the oil stocks in here because I don't think the stocks, you were never paying for $100 oil. I don't think even you're really paying for $85, $90 a barrel of oil. I mean, these companies at 70 to 75 are still probably trading around 4 times operating cash flow and kicking out enough cash that they continue to do the buybacks that they're doing, increase the dividends, turn the money back to shareholders, which is just sort of positive in the short term. I mean, longer term, you've got to revisit this whole situation. I mean, longer term, you want to sort of maybe continue to ride this wave for a while, but I'm looking at alternative energy because I sort of look at what the demand is down the road for, basic carbon fuels that will decrease over periods of time. So, I'm certain, the Boralexes and the Northland Powers and those types of names we look at, they will substitute at a point, but when traditional energy oil names are trading at 2 to 3 times operating cash flows, and these guys are trading at 10 to 12 times operating cash flows. It's hard to make that switch right now. That was the case, though, for so long.
Yeah. But the most generalist investors kind of turn their back on the sector because of what you were talking about, that, you got to have this ESG portfolio, and that's just got to be how you orient yourself. And at some point, it just became too much of a screaming buy, I guess.
Yeah, exactly. And, I keep thinking the energy companies themselves, I know right now all the shareholders are screaming, give the money back to us rather than, for years you invested it in more oil development. Now we want dividends, we want buybacks and all of that. I think it would behoove a lot of these companies almost to take the lesson of tobacco from the 1980s. When you get into a slower growth industry, what do? You take that money you invested in other growth businesses. I think some of these energy companies maybe should take some of this excess cash flow and put it into renewables. Sort of, they know the energy business.
How would that go over with investors?
Well, yeah, probably not that well in the short term. But in the end, like I say, what made Philip Morris probably a very good company is not cigarettes. In fact, they took all that excess cash flow from that and reinvested it in mostly profitable businesses.
I got to ask you about this. So we spent a lot of time talking about WTI. It's at a 2-month low, but the Canadian oil price has languished even far below that and is trading at, looks like at least the lowest point so far this year at $51. The differential is widening out. Is that a big problem?
I'm glad you mentioned that because I don't think it's been talked about a lot, and I think you should factor it in because you look at the Canadian natural resources. A lot of the guys who sort of count on more the WCS oil within Canada are probably going to get squeezed a little bit more. So in some of the holdings, I'd rather have the guys that just have a little bit more U.S. exposure as well. Maybe just sort of in Dakotas or areas like that across the border.
So you got Whitecap, Crescent Point, TC Energy. Does that give you some immunization?
TC was just maybe more of a pipeline play and an Enbridge. I mean, I just sort of looking a little defense in the portfolio as well. The stocks have come down. I'm looking at 6% plus dividend yields. I thought, boy, that's nice in this environment right now. So.
What's ailing the Canadian oil price? Is it what has ailed it? Because I thought we kind of, the takeaway constraints, I thought were largely, we moved past that.
Well, we haven't. We still have a transportation issue. We can't get into the markets we want to, so you're going to have, you can get sort of more localized supply gluts than you will sort of in WTI as well. So that's still obviously a problem for the spread right now.
We've got Canadian banks set to report in a few weeks, and I think there's a little bit of caution out there on how exactly are they going to fare on the eve of a slowdown. How are you thinking about the banking sector?
Yeah, I'm almost not in them at all right now, which is hard in the Canadian market to avoid. You'd be out of a sector like that. I have proxies and other plays, and we have U.S. banks in the portfolio to agree. I think there are some headwinds facing them. A lot of the tailwinds of the past 2 years, like bringing your loan loss provisions, the excess you took at the beginning of the pandemic, taking it back into the income statement, that'll disappear. Obviously, they benefit from the interest rate spread, but loan loss provisions, I think, are going to start to be rising again. Capital markets activity is going to slow down. So, I think there's some issues for the banks. Like, luckily, the valuations are at the lower end, so I don't think you have to run for the hills, but I just don't see a lot of upside, and I will be interested to see what happens, what the numbers are and what the stock reactions are once they report.
One sector that you're looking at, which is interesting, is the autos and GM and Magna, super, super cheap names. But not without their issues and headwinds. Why do you feel comfortable kind of stepping in here?
Well, it's interesting, Amber, because, typically when interest rates are rising and we're worried that you're heading into a downturn or recession, autos are probably the last thing you want to be in.
Yeah.
But they already reflected that. They've been acting like they've been in a recession for the last 2 years. Obviously, the auto sector got hurt dramatically with the supply chain shortages on semiconductors in particular. So you look at it right now, auto inventories are dramatically low. So you don't have the typical buildup at the end of a cycle or whatever. You see excess inventories like you've seen in retail, and when all the retailers are the issue. Auto inventories are basically almost non-existent at this point. So the demand and the production will still be strong. And then you get, obviously, the migration to electric vehicles over the next couple of years is going to continue growth there. So, and when you get GM trading at, 6 to 7 times earnings, I think they'll do a good migration across to electric vehicles. They have positive cash flow, the good balance sheet. It's not like the parts companies can migrate to the EVs very well from the internal combustion engine vehicles. I mean, outside of what's in the drivetrain, 90% of those components are going to be similar in both kinds of vehicles.
What's your split Canada-US right now? Because Canada has, done relatively well this year.
Yeah, we've probably shifted more money up to Canada in the past month just because I was a little concerned about where the dollar had gone. I keep thinking the U.S. dollar is going to come off the boil a little bit. It's been, it's been sucking the oxygen out of the room for every other investment for a while, and it's going to end, particularly if the U.S. economy starts to slow down at a point and you get the Fed maybe having to back off on that interest rates as other economies grow. I think if the U.S. dollar comes down, the Canadian dollar can rally. So I was a little reticent to up my U.S. investments at that point. So in comparable industries, the past month it has, for sure. The past couple of weeks it has.
I know. I think we've talked in the past about Shopify, and I remember when it was going up, you had this kind of complex relationship with it, wanting to short it, but it was very difficult to do so. Obviously, this year has not been great for Shopify. Are you looking at tech at all? Would you pick up this name?
There's a lot of names we're looking at in that tech sector. Shopify particularly, no, because it's still relatively expensive. I think they're running into some, obviously, margin problems. You look at the last couple of quarters, they've missed the numbers going forward. So I'm not as enamored with that, but there are lots of other areas. I mean, in that same sphere, I think Lightspeed looks interesting in Canada. We got in the U.S., we've got, all the payments companies, PayPal. I think the semiconductors, because of the, there's a shortage there going on and continued growth, even though they are a little cyclical. Qualcomm, AMD. Sort of got NVIDIA on the radar screen, but we haven't added to it yet. I mean, SMH is a semiconductor ETF that you can play it generally, but then you get Intel. And what was interesting, Buffett came out the other day and he took a position in Taiwan semi as well.
That's right, And it was years ago that he was scooping up energy, so maybe he knows something that we don't about the semiconductors. But it's interesting to look at that because it's often viewed as like the new industrials, right? They're very economically sensitive, so that you feel like you can step into semis at a time where also saying, we're probably going to get a recession. How do we do those two
things? Well,
things?
it depends which industries are in, too. Because, I mean, the smartphone, if you're too tied to smartphones, that's a bit of a problem. But, like I say, the autos have to pick up again. The demand's there. Obviously, what you've seen in gaming, in data centers continue to grow when you look at, the numbers even released from, Amazon and Alphabet and Microsoft, that continues to grow. So there's going to be lots of demands for semis. And it's a penetration, as you know, Amber. I mean, semis are going into absolutely everything. I like the way you referred to it. I mean, the modernization of the industrial structure. Your term was exactly. That's exactly what they are. They are the growth sector. They're the growth sector of industrial.
But that brings me to my point about old world industrials, because they've been doing just fine. Take the train stock, CP Rail's outperformed. You're seeing some good momentum in CN Rail, and there's a lot of discussion about how the Canadian rail is perhaps more insulated from any slowdown that might take place in the U.S. Are you taking these rail stocks anywhere?
Well, we've had them. We've had some of the industrials in there. I'd be more likely to lighten in there, Amber, because, like I say, my view on the economy is we're headed for a slowdown in 2023, and those stocks, the multiples have all gone up. If I can... why would I pay the same multiple for CP Rail or CN that I can get Alphabet for?
Is that what it is now?
Yeah, I think so. I think they're under 20. You know, they're sort of in that range. And I thought if you look across a lot of that, I think, you know, I'd rather pick up the things that are a little bit more distressed and have underperformed rather than industrials that are more sensitive. And I mean, Alphabet and those other guys are obviously sensitive to a downturn in ad spending.
Yeah.
You know, maybe cloud spending slows down a little bit, the enterprise spending. Yeah, so there's risk there. But I just think some great growth stocks have been decimated this year. So we're sort of looking through. So I still got an overweight in tech, but to your initial question, Shopify is not one of the names.